Hello everyone, how's it going? Today we're going to be going over something more educational, I suppose, rather than analysis on stock market or crypto market. And today we're going to be going over swing highs, swing lows, and everything you need to know about them and how to identify them and how to use them for trading. So, first of all, a swing high and swing low can help you identify pivotal movements in the market where you can say to yourself, okay, we have achieved said swing high, swing low. Now I am more confident that these lows and highs will hold, and therefore I can continue my analysis with this bias in mind. So rather than something like an order block, an imbalance, or fair value gap, where you use these as actual levels to trade from, a swing high and a swing low is more of a visual cue for yourself. So you don't necessarily use it to immediately take a trade off of. You wait for it to form and then make your analysis based on that. So really quickly, before I even deep dive, I'm going to state the obvious. Number one is that we have this lovely thumbnail to give you guys a quick, easy visual before I deep dive into the actual chart of what a very basic swing low looks like and what a very basic swing high looks like. Now, to I guess break it down for you guys, essentially it's when we have for swing low a impulsive low that's made, a low following it, and then we have a very impulsive move that engulfs the previous candle to almost create this mini head and shoulders reversal, like reverse head and shoulders movement, and you sort of create like an actual head and shoulders movement on the candles. Now we'll be going over how to actually identify these on the chart, but I'm pretty sure if you guys look at the swing high candle here and you guys look at the swing high candle here, you can already spot the similarities. An impulsive move, a following move up to create a higher high, followed by an impulsive move down to engulf the previous candle. So this is just a very basic, it is very visual. Now, unfortunately, it is something where there is no strict 100% criteria because there are variations of a swing high and swing low. It's not always going to be picture perfect. You will have to, and I will go over the other variations as well, of course, but it is something where you have to just train yourself to find it, rather than just, going with what I'm saying and that's it, not elaborating on yourself any further. Now, if we go over 6 month, here is another example of a swing high. I'm basically so what I'm going to do at the moment is I'm going to go down the time frames and just kind of implant it into your head and describe why a high like this is a swing high and a high like this isn't. So a high like this over here is considered to be a swing high for two main reasons. Number one, we had this impulsive sort of swing failure pattern movement of this previous candle's high before rejecting. And number two, we also had a impulsive move down to follow it. In this case, and not always, we have created an order block after forming the swing high. So we say to ourselves, okay, we have our bias set after creating this formation. I did not trade this because I am waiting for the swing high to form, and you cannot understand or you cannot see that the swing high formed until you have at least a total of 3 candles informing you. So let's say, for example, this price action didn't happen. You cannot say to yourself, okay, we have a swing high here because this candle didn't happen yet. You need to wait for the previous candle and the candle that forms a swing high plus the candle that potentially engulfs the previous candle, which is this one, to form the swing high. Now, typically when this happens, you leave behind an order block, you leave behind a fair value gap, an imbalance. In this case, we had this massive order block. We also left behind this fair value gap down here as well. And I'm just going to label this to show like some difference. So we left behind an order block and we left behind a fair value gap. So when I mention in my head, or not my head, but to you guys in the chat, I'm like, okay, my bias is for price to head lower. Why is that? There are multiple reasons, but one of them is revolving around the idea of the swing high or the swing low. So if I see a formation like this, which again, just to implant it in your heads, looks very picture perfect, such as this one, then I will typically mark out an order block or fair value gap that forms once it's made, and I will look for some sort of re-entry at these levels to continue the trend. This is indicating to you that there's a trend shift or a trend reversal from this move up, and this is your opportunity to take advantage of it. For a lot of people, yes, you can take a short trade of the swing failure pattern, whatever it is, but if you want to play it more safe and also still be involved in the trade, then this is what you should be looking out for, these levels of interest. So that is really quickly just explaining the basics of a swing high and swing low, what to mark out, what to look for. And of course, this is on the higher time frame, so it is quite easy to spot. So we'll go into the lower time frame. I think a lot of people are familiar with the concept of confluence, where you essentially need to identify more than one level to be confident in said level, to say, okay, for example, 30K or 31K is very strong because I have volume, I have an order block, I have fair value gap, I have this, I have that. A similar concept can be said about the swing highs and swing lows. So if you, let's say, for example, take this high, you want to take confluence, and you know how I think some of you might be familiar with the concept of the yearly, a monthly, weekly, daily chart, or like the daily levels, I mean, and the monthly and the weekly and whatever. You understand that the monthly levels are, stronger, I guess, than the weekly levels because they're on the higher time frame. Well, it's the same about a swing high. If we form a swing high on a super high time frame, I'm talking like the yearly, and you start to work your way down and you see consistency. Okay, swing highs available on the month, on the yearly, on the 6 month, on the 3 month as well. This is another variation which I'll go over of the swing high. And on the 1 month as well, over here, you see this pattern form, then you say to yourself, okay, well, this reinforces my bias and it has more confluence of holding until you reach a major pool of liquidity before the saying that, okay, the trend can be reversed. So you cannot identify a swing high or a swing low on the high time frame by going down to the daily or the 4 hour or the 12 hour and so forth and so forth, whatever. However the saying is, you need to start with the higher time frames first, depending on what kind of trader you are. Now, if you're me and you're looking for a trade, that could last 6 months, 3 months, 6 months to a year, then you need to put emphasis on anything from the weekly, monthly to the yearly chart. These levels are what you need to look for to create your bias. If you're someone who wants to day trade or maybe take sort of like smaller swing trades, like maybe that last a month at max, then you could start looking at the weekly, daily, monthly, and lower. You don't necessarily have to go all the way up to the 12 month. So keep that in mind, but you have to also understand how to mark things out on the 12 month because it also helps you form your bias on those lower time frames. So if you want to be able to get higher probability trades on the lower time frame, you need to absolutely be able to mark out the bias on the higher time frame first, because that will help you avoid any lower probability trades on the lower time frame. You start to understand, okay, I can trade towards this bias since this high is so that this is essentially how you could have traded this area here, which unfortunately I wasn't really active in the community back then, but we won't even talk about it because it's now just hindsight. But for educational purposes, you have this high here, a swing high on the monthly that has formed. You only know that a swing high is formed after this candle formed. You did not know that this would be a swing high until we got this drop. We got this drop. You're sitting here stuck out of a trade and you don't know where to enter. So you start to think to yourself, okay, this is the swing high area. we have this imbalance starting from, if it loads, from here to here. If I just mark it out in red, because red is bad, green is good. This imbalance zone, and also, of course, fair value gap if you want to mark it out. And you say to yourself, okay, any movement into this area is a potential short trade, because I understand that this high will hold. And what else? I also understand that we have a major pool of liquidity below us that still hasn't been taken out. So in very, very simple terms, of course, you can go down to the lower time frame, because if you look at it like this only, which I don't do this, you're literally like, looking at it like this, which makes no sense whatsoever. This is where you kind of just understand the level and then refine a little bit more where your stop loss is potentially going to be based on this move down here. So for example, okay, I marked out these levels on the monthly, I go down. Now I can mark out this order block over here as well and use it as a reference point. And if you guys remember how I usually like to trade order blocks and put my stop losses, it would look something like this, down to the liquidity zone like this. So you went from something that looked like this to something that looks like this, just by swapping time frames by not that much, monthly to weekly. And of course, you can get even more refinement going down from the weekly to the daily using this method. Just for demonstration purposes, I will do this quickly. So yeah, again, we have this imbalance or order block zone over here, and price just goes up into it, and it's pretty much the same stop loss actually going down to the daily. If you come up here and then go lower like this, then there you go. So yeah, the swing high can be used as a way to create your bias, and it also tells you, okay, I need to be patient. I need to have some, hold my fingers away from my keyboard or my phone or whatever and wait for said swing high. We can look at something more recent here before making my decision on a trade. Now, I want to also step back a little bit and go over some criteria that you need to understand for the swing high besides all of this. So number one, a swing high can only truly be formed after taking a liquidity pool. So what do I mean by this? I'm just going to quickly sideline the chart a little bit over here. And again, I think I've said this word like a million times, demonstrate what I mean by this. So you have this sideways range going on. Not even necessarily a range. It doesn't have to be a range, but just this side, like this price action happening around here, like so. Price is just moving like this. And you could say to yourself that, okay, I would like to take a short here because we took out the liquidity of this high. But we didn't form a swing high, because what does a swing high look like? A swing high looks something like this, where we would, come on, load, where we would go up, test this resistance, make this low, come up to the high, and then engulf this low over here before moving up. Then you have a swing high that is formed over here. Not just a move up that takes out liquidity, then just ranges sideways. It needs to be aggressive, and it needs to happen pretty immediately, to be honest. We have this move down that takes out the previous candle's low, engulfs it, and then you say to yourself, okay, we engulfed the previous candle, we have created the swing high candle. Now I can create or look at an order block or imbalance or whatever it is in the zone of where the swing high was formed before making my trade for price to head lower to this pool of liquidity down here. And it would essentially look like this, where you would take your trade and your stop loss would be at the high over here. So you don't necessarily take the trade up here. You identify the swing high movement based on, again, something like this, if you get a move like this, an engulfment, this candle would now be referred as an order block, or you could get some sort of fair value gap and imbalance depending on how deep this candle goes. You can make your buys off of that. So I want to also go over some, this is going to be a lot faster if I just complete it like this. Let me just quickly go back to the higher time frames. I want to also go over a more complex way, I suppose, of identifying a swing high, which is when you have something like this. And I think a lot of people would see this and be like, oh, this is like, some sort of BART where you go up range, and then just drop immediately. And to be honest, because of how long this range has gone on for, it's pretty hard to say that this is a strong high. And if you also look to my left, you'll see over here that this high that was made was not a swing high. Now, why am I saying that? Is because of two things. Let me just mark out this candle, this high and low. So let's mark it out like this, just so that when I go in the lower time frame, I can spot it. And let's go to the lower time frame and like kind of like dissect it a little bit. So you can see like something very, very similar happening here as to what happened here. And what is that, you might be asking, is we made the high and we didn't move down aggressively at all. We ranged for 1, 2, 3, 4, 5 days near this high. So a lot of people could have very easily done this. And it would have been no sweat whatsoever. And this move didn't even stop them out. Something similar over here. We made this high and are now moving down. But you can see here we've ranged for, who knows how long, basically. And not only that, but we're also doing this below $30,000. So it's very easy if I just mark it out like this. 30,000. So it's very easy after this high was made, rejection, because remember, people aren't always looking at the 1 hour or 4 hour. A lot of people that you'd see like trading this are on the daily and they're looking for daily candle closes. Like, oh my God, if we break back above and see candle closes, kind of like what we saw here. Like, look at the chart, look at this. This is kind of like a support resistance thing. And this is a very easy way to also navigate liquidity. Price moves above. So many candle closes on the daily chart. Like, people are going to be longing the shit out of this. Everyone's longing this, and everyone's saying to themselves, oh my God, we had like daily candle close, we had weekly candle close, whatever it is. I'm now longing $30,000 as support. This is now support, and we're going to go higher. We don't. We go down, and now the daily candles sort of just like reject. And everyone's saying, oh my God, $30,000, super strong resistance, not going to break. We're going to die now, and we're never going to come up and take this out. When in reality, this is kind of just setting up a lot of liquidity, because the majority of people would be trading it like this. So short, or, I don't know. I doubt a lot of people call this short, but anyways, you get the point. You get the idea. So a swing high needs to not have any liquidity built up near it in order to be valid. Take this low, for example. This low here was super aggressive. We came down, we took out liquidity at $20,000. Oops. And price literally spent almost no time before just impulsing up. And again, look at that swing low candle over here and how it formed. Very picture perfect. Again, just to pull it up side by side. Check out the swing low over here. Move down, lower low, then a higher low, and then just like straight impulse up. So this is something that you want to see ideally in a swing high and a swing low. And you're saying to yourself, well, Dan, there was like no way to catch this. I didn't catch this, and price, had all this movement without coming back to it. And This is how, and if you go on the weekly, actually, you'll see that it's way more prominent over here. Like, look at this again. Just so I'm really trying to just hammer this picture into your heads so that you guys can understand what I mean by swing low. Like, look at this. It's pretty similar. Yes, the candle body isn't as full, but doesn't need to. The whole point of it is just impulsive move down into a liquidity zone, $20,000 imbalance, strong buyback, or strong buyback in the candle following it that engulfs it. And this is pretty much exactly on point with what you want to see in a swing low. So again, no ranging happening like here or like here, and literally just an impulsive move up. So what does that mean? That means not a lot of people caught this long. And what does this mean for us? Because we've identified it. Okay, cool, pretty. How do I actually trade it? If we kind of just like analyze it a little bit more. Okay, this candle kind of engulfed it as well. So the engulfment or the swing low starts on the weekly, because this isn't really a swing low on the monthly. It's kind of just engulfing candle on the monthly of the previous month's low. So you kind of say to yourself, okay, this is a pivotal low. This is a strong low over here, if it ever loads. So that means any trade that I take, this can be used as an invalidation point. So let's mark it out as invalidation. God help me with TradingView. Whenever I open up OBS, it just like spazzes out. So fair value gap. Oh my God, not fair value gap. Invalidation over here. So this is your invalidation point. You don't want to see price come back down here in order to be bullish. Actually, because I don't like this chart over here, I'm gonna remove this. Again, invalidation over here. Let's just redo it. Like so. I'm gonna type it out because I cannot be bothered to open up the template thing again. And now you can say to yourself, okay, any trade that I take, that I can use this as an invalidation point. So you understand that this is the swing low. And you can also understand from my lessons about order blocks that these series of down close candles can be used as a order block. Like so. If you want to be, way more refined, you can, just do this. But I'm kind of just being a bit more generous, like even like this. You don't have to select all the down close candles. You can select the last 2 down close candles before the higher impulse up. I'm talking, of course, in the higher time frame. And then use this as some sort of level of support to look out for. And generally use this as a invalidation point for your trade. Now we have the swing low formed, and we've never gotten a proper retracement down into these levels. So that means this is still a valid support area to look out for. Another thing you want to point out is, okay, we have an order block, we have our swing low. So we understand that we are looking for a trade on a level that this swing low created. You do not trade necessarily this here. You trade the retracement into the swing low area. So you have your order block, and you can even mark out your fair value gap over here on this one. The fair value gap starts here, or I guess ends here. I'm gonna do from here because I can't be bothered. Fair value gap. Like so. Okay, nice. You have your level. You also have to mark out liquidity levels, of course. And that falls here on this double bottom. Like so. And you can also mark out things like 24K liquidity or 23K liquidity. I kind of marked out 23K if you guys haven't noticed, for a couple of reasons, which I'll go into in a moment. Like so. So why did I mark out 23K on this? If we go down to the 4-day, you can see that we have a order block here on this candle. And this order block is, I find it really nice. And to be honest, 24K comes above these series of order blocks over here. So 24K comes higher, whereas 23K comes inside of these order block zones. So because this liquidity pool is closer to the level of interest, I'm simply just marking out 23K. You could mark out 24K, but I just realized that the liquidity pools that are closer to the levels of interest are just more important because these will act as magnets as well. And if we go down to the daily chart as well to analyze it a bit deeper, you can see that 23K is what comes into this area of imbalance over here. So if you just mark it out like this, you can see that this is our imbalance here. This is our fair value gap where these series of down close candles, I guess, start. You have your imbalance and you have your liquidity pool and your fair value gap. So you can say to yourself, I'm going to keep my eye on this whole green area. However, I am more inclined to pull the trigger when price comes down to this zone here. And then your trade will look something like this, essentially. You know, like you could say up to this high. Because if this swing high, or sorry, not swing high, if this swing low has been, kept throughout this whole movement, then that typically means price will want to retrace into it before it makes another move higher. Not only that, but also because we didn't get any proper swing highs on the weekly or the daily or even the monthly, to be honest. We have had the swing high here form, but at the moment, it just seems like there's been a lot of moves up close to it, which means that there's a lot of liquidity building up. Again, I would say use these as reference points because, I mean, check this out, like literally no time spent here in this zone, whereas here it's not the case. I think another thing I should elaborate on is because you guys would look at these side by side and be like, well, Dan, isn't this a swing high? And it is. It is. Absolutely it is. This is also a picture perfect swing high. Now, I think where it gets confusing is if you just look at it like this and you don't dissect it on the lower time frame. Let's mark out the high here and then, just go lower and lower on the time frames. So, I mean, we've had our swing high that formed here, and then we had this move up as well to create a lower high, which, I want to say caused an easy short trade, to be honest, for a lot of people. Over here, if we go down to the daily, you can see it more clearly. Price kind of just went up really, really close to the swing high area and then just, pretty much went down. Why is this high not as good as this? Is because look at the difference between how this high moved down and this one. This one gave people an opportunity to short. This one didn't. Like whatsoever, unless you were super smart about it and have taken trades here or here based off of the ideas that I'm telling you about on imbalances and order blocks. But for the general public, if your trade can be easily decided by a fib like this, which the general public can do, they can just mark out any fibs and take a trade off of it, then chances are it's gonna get run into again, like so, and very, very soon. So you have to keep that in mind. This is a much better swing high because literally there was I think maybe just one here locally, if even. Did we even go into the fib here locally? Like we did exactly, but it was pretty immediate. And then we just literally died. Like there was no time to think about it, I guess is the best way to describe it. We had days here for people to potentially short and put their stop loss at this high. Here, not so much. Pretty immediate moves. The only consolidation we really had was when we dropped $20,000 worth of price. And then it decided to range in a very choppy manner. So that's another thing you really need to understand about these swing highs and swing lows. That's why this is a valid swing low. And that's why this isn't a valid swing low as well. And that's why these are not great highs whatsoever. It's because, again, compare these highs over here to this low and compare these highs to this one that we had over here at our first initial high back in 2021 and to our high up at 2020. Well, they're both in the same year actually, the end of 2021, I guess. So you can kind of just start to make similarities in them, start, to compare price action and start to understand like, okay, what makes a decent swing high, what makes a, bad swing high or a poor low or poor high. And you can typically find that out by just watching for price action to consolidate. I'm also going to quickly go over something with you guys that relates to a previous trade that I've given. Actually, it's going to be something over here locally. Actually, I'm gonna go over local price action here. I think this is the first time I ever go on the 15-minute chart on stream. But for, I guess, the local stuff, I need to go back to Bybit. And let's go on the 5-minute. Okay. I'm going to go over what I kind of gave in the chat. And it was something like this, where I said to you guys, okay, I'm looking for this area of imbalance as a resistance. Now, anytime I give you guys a area of resistance, I am actively looking for invalidation before it even takes out the high, which is, let's say, for example, I took my trade here or around here somewhere. Let's say this is where I took the trade. I took a short here and I'm like, okay, guys, I'm in a short and I'm waiting for price to go lower, to, let's say, down to here. Where is it? Let's say I'm looking for price to go down to here as an example. I'm like, hey guys, this is my short trade, whatever, it doesn't really matter, stop loss, and I'm looking for lower. Now when I say this and when it happens, do you guys just blindly hold it even when all of this happens? No. The reason why is because we did not get a good high. Why is this not a good high? Well, it looks like a good high here because we got a pretty aggressive move down. But look at this price action that followed after. We haven't taken out this high yet, but we can already tell through this consolidation period here that we have a lot of liquidity built up automatically. And what happened is we went up and took it out because people kept shorting and shorting and shorting, placing their stop losses here. And now they all got wiped out, essentially. And we front ran 29K by $1. Wow. Okay. So this is another thing I wanted to bring to your attention, is that a swing low and a swing high is also determined by, price action that follows after. We have this high. It's a pretty awkward high. You can consider this a swing high over here on the 5-minute chart, sure. But like I said, you need to also go on the higher time frames to identify this. And on the higher time frame, it is not a swing high whatsoever. 12-hour daily. Now, why is it not a swing high? Is because we've had a lot of consolidation. It wasn't a high and then a higher high and then a quick move down to engulf this candle. Instead, it's just, some sideways price. Going on the weekly and the monthly, again, nothing really sticking out for me to say that this is a swing high. But it doesn't have to be at the moment. It just means that this will get taken out at some point. It doesn't mean that you have to keep longing here to keep targeting this area. You could say to yourself, actually, wait, I feel like I didn't even finish my point. I mean, it felt like I did, but I'm not sure that I finished my point. Sorry, I brain farted there for a second. But yeah, let's say I say to you guys, hey, I'm looking for a short, and I go to sleep. I'm literally in bed. I'm like fast asleep. And you guys are awake in whatever time zone you're just awake. And you see something like this happen where we just range sideways. That's your sign to either just get out while it's still in profits or just be extremely stingy with your stop loss and set it to entry, because having a high made and then just followed up by range is literally the market telling you, hey, get out. Like literally, hey, get out of your trade now before, this happens. So anytime you see like high consolidation near your area of, resistance or support, it's a red flag. That's my main point, I guess I wanted to try and say. So yeah, going back to the previous point I wanted to make, is when you understand that this isn't a swing high, you can start to say to yourself, okay, I understand that this will get taken out at some point. Doesn't have to be now. It can be, when we take out more liquidity below. But where do I say to myself, okay, this will no longer be taken out anytime soon, at least. Like, lower prices are to come before this gets taken out. Look at any sort of order blocks or imbalances that formed before this move and use those as a reference point. Like so. So this is I guess, I don't think on the daily there's any order blocks that formed. We just said weekly 28. I don't think we have anything really. 28. So yeah, price could just range, create liquidity, come down here, bounce, and then come back up to take out this high. Invalidation for this idea is literally just breaching this order block. Because as I mentioned before, order blocks can also be used as a way of saying, okay, there's been a shift in what's the word I'm looking for? In market structure. So the shift in market structure here is taking out these lows and taking out the order block completely and breaching it and then heading lower. Or, just, it's a sign to say, okay, I'm using this as a reference point for my stop loss. Like so. Whoops. And you can look for higher based on that. You can look for $29,000, take it out this high, maybe one more time, $29,000, all the way up to potentially this high over here, which is a bit generous, if I'm being completely honest with you guys, especially because this is a Bybit wick and I don't think any other exchange went up this high. So yeah, but just for, I'm not saying this is a trade to take all the way up to here or even all the way to, it's just a reference point. It's a visual guide to let you know we will not be taking out this high here if this is breached and heads lower. So use this as a visual point. Don't use any of this price action here to be like, okay, we're never going to take out this high. It's done. It's over. It's not over. It's not over until this gets breached. So this gets breached, and then you can say to yourself, okay, we are now heading for potentially lower areas of liquidity. But as it stands, that is not the case. You have your reference point here, and you can use this to your advantage. So yeah, not a swing high. Although we didn't range close to it, we still haven't taken out any invalidation points. Sorry, I need to drink some water. My throat is, excuse me. I think this is the longest stream I've done in a while. And my voice wasn't prepared for it. So reference point, area of interest, potentially, if this holds. And then, going for lower if not. Yeah, I think so far that's kind of like the main chunk of what I wanted to explain and how to identify it. So I'm trying to see if there's anything I'm missing. I feel like I've explained a lot of it. I'm just trying to make sure I covered all grounds. Okay, I mean, if I remember something that I just can't in this stream, I'll message it in the chat. If you guys generally have any questions or like realize that I missed something crucial, then please share it in Discord. I'll go over it in the discussions channel with you guys. Also, I'm really like happy with like how much more engagement I'm getting in there. It's really nice to see. And I'm more than happy to answer all your questions when I get around to them. So yeah, anyways, I think without blabbering on too much longer, I'm gonna call it here. And yeah, again, ask any questions in the Discord. I'll be there to answer. Hope you guys enjoy the rest of your day, evening, whatever it is, and I'll see you on the next one. Bye bye.